They're like, hey, does this have a bonus? Okay. I was told by this other advisor, I get 20% bonus. I put $100,000 in, I'm going to have $120,000 right there. It's great.
Hey, welcome to the Guaranteed Retirement Guy Show. So I want to talk to you about some mistakes that people make when they are looking for annuities. In fact, I'm going to talk about 7 mistakes that you don't want to make when you're looking for an annuity. Let's talk about mistake number 1. And this is thinking that you can get out of an annuity at any time. This is a huge mistake because annuities, typically, if it's a fixed annuity, you might have a 5, 6, 7, 8, even 10-year term, which, you're getting a guaranteed rate of return, which is great, but you can't really get out unless you want to incur some surrender charges. It's not like a bank account, okay? You're not just putting money in and take it out whenever you want. You do have access to some of the money. A lot of times they'll give you like a 10% withdrawal privilege every year where they don't charge you any penalty for that. But you have to remember the reason why you're purchasing an annuity. If it's for guaranteed income and the highest ROI from your money, then it's phenomenal. But if you're looking for something that's more liquid, then that is a big mistake you do not want to make. Okay, so mistake number 2. This is thinking that you're going to get optimal growth. Okay, I want an annuity with tons of growth, tons of income, tons of safety. I want it all. Okay, so I want tons of growth, which a variable annuity could give you because it's part of the market. But I also want tons of safety, right? So you can't get that with a variable annuity. You have to have a fixed annuity. With a fixed annuity, you will get safety, but you won't get huge amounts of growth, okay, that you might get from a variable annuity. There's a big mistake that people make thinking they're going to get the best of all the worlds. I want my income, I want my growth, I want my safety, I want everything to be everything like perfect, okay? You're not going to get that all from one annuity. You're going to get parts of it, but a lot of times when you are thinking to go hybrid, it's better to purchase a couple of different annuities for different purposes. Mistake number 3, pursuing the best bonus. People love bonuses, okay? When people talk to me,
They're like, hey, does this have a bonus? Okay. I was told by this other advisor, I get 20% bonus. I put $100,000 in, I'm going to have $120,000 right there. It's great.
So that's going to make you feel pretty good. But if that annuity does not have a high amount of income and that is your biggest goal, you might be better off looking at an annuity with no bonus and be able to get a lot more income and a lot more ROI over time. Another thing to think about as far as ROI and growth is when you purchase an annuity with a bonus, a lot of times, not all the time, but a lot of times they will cap you significantly on your growth in the future. Okay, so you're getting everything up front, but terrible growth long term. Okay, you have to think about that when you're looking at bonuses. What is the real purpose for that annuity? Is it growth, long-term growth? Is it income? You'll notice that if you're looking for a specific goal, you want to go after that annuity that's going to give it to you regardless of what the bonus is. Okay? All right, mistake number 4, not considering the consequences of how the annuity is funded. Okay, so what this is basically if I put non-qualified money in versus qualified, okay? And not only qualified, but maybe it's coming from a tax-deferred account versus a Roth account, okay? So on the qualified side, yes, and most of my clients are like this. They will have a qualified account, usually a tax-deferred 401k, 403b, TSP account, you name it. You have all these employer-sponsored plans that they're trying to move money from into an IRA, which is also a qualified account, but now it's owned by you. All that money comes out, taxable, just like it would out of your 401k or IRA if you didn't have an annuity. The difference is you have the contract that's guaranteeing that income for life. Now, with a Roth, of course, if you fund an annuity with a Roth, it's guaranteeing you the same income, but now it's tax-free. It might be worth it depending on what your tax bracket is now versus what you expect it to be later on, as well as your life expectancy, longevity, and a lot of other factors to consider. Now, if you fund it with a non-qualified account, meaning like a brokerage account or a bank account, money under the mattress, you still own the same annuity, still giving you the same guaranteed income. The difference is now it's just taxed differently. because you're putting money in, which of course has already been taxed. You're never going to be taxed on that when you take it back out, but you're going to be taxed on all the earnings. So that's how those work versus the qualified accounts. All right, mistake number 5, confusing different rates. So let me just go over that real quick. You've got a cap rate. A cap rate is just a cap. It's a cap on what you can earn, or up to what you can earn. So if the index does 10%, you can earn up to the cap, which if the cap is 9%, then it's 9%. If the index does 12% and you're capped at 9, you're only going to get 9%. So remember that. A lot of indexes in annuities have cap rates, and these can range from 6 to 8, 9, or 10%, sometimes more. So you also have participation rates. Participation rates are how much you can participate in the index. Okay, so if the index does 10% and your participation rate is only 65%, then they're only going to credit your account 6.5%. That's why when I'm looking for growth annuities, I like to look at not only participation rates that are over 100%, but I also like to look at companies that have a good track record of keeping participation rates high all the time. Mistake number 6, taking out withdrawals without seeing the potential impact. A lot of annuity contracts will give you a 10% withdrawal amount where you can take it out penalty free, and that's fine. You can do that. But if you're using that contract for guaranteed income later on, and your agent has told you, hey, you're going to get $50,000 a year based off of this, it's based off of that. It's not based off of you taking out 10% every single year because you're allowed to do it without surrender charges, okay? You just need to realize that that provision is in there to allow you to take money out if you need to. But again, it's good that you have savings elsewhere so that you don't have to touch this, because by taking that out, that is going to affect your guaranteed income later on. Mistake number 7, believing that cap and participation rates are good for the life of the contract. They are not, okay? They are only good for that period. So if it's a 1 year, which is typical, or 2 year index, that participation rate, that is only good for that 12-month period. Or if it's a 2 year period, it's only good for that 2 year period. So when you put money in these indexes and you're seeing 250% participation, you're seeing cap rates of 12 or 15%, that looks great, but those cap rates and those participation rates don't last, okay? They change, and they change at the end of each period. So if it's a typical 1 year index, at the end of the index period, at the end of the 1 year, when you get your credits and you get your growth, they will then usually reset the rate. Your contract, which if you plan on keeping it 30, 40 years, put it with a company that has a good history of keeping those rates high. Otherwise, you're going to be in for a rude awakening if you put it with some company that is just giving you a teaser rate and then they drop it in half. There's a lot more pitfalls or mistakes that you can make by purchasing the wrong annuity. And if you want to go over those, or if you want me to show you everything that's available and explain how they work, and we can look at your specific situation, book a call. You'll notice that there is a link below this video, and we can chat. We'll talk about your situation. If you're looking for income, great. If you're looking for growth, awesome. It really depends on your time horizon, how old you are, if you're married. We'll look at all that. Hey there. I hope you learned something today. If you have, share your thoughts in the comments section below.